All right, let's dive into a topic that pretty much everyone feels, but let's be honest, very few of us feel like we really understand inflation. We're going to explore a pretty provocative idea today. What if inflation isn't just something that happens to us? What if, as our title says, it's actually a choice?
Yeah, this probably sounds familiar, right? For most of us, rising prices at the gas station or the grocery store, it just feels like bad economic weather. It's like a storm we just have to ride out. It's frustrating, it seems totally random, and it really leaves you feeling powerless.
But what if that feeling is based on a fundamental misunderstanding? You see, what if inflation isn't some force of nature at all, but the completely predictable result of specific, deliberate choices made by policymakers? To really get to the bottom of that, we have to start with the most basic question of all. When we're all talking about inflation, what are we really talking about? The first thing that jumps into almost everyone's head is inflation is when prices go up. And look, that's not wrong. It's the symptom we all feel in our wallets. But it's also a really superficial way of looking at it. It tells you what's happening, but it completely misses the why and the how. Okay, so here's the big shift in thinking we need to make. The real mechanism of inflation isn't that your groceries and your gas are suddenly becoming more valuable. It's that the money, the dollars you use to buy them, is getting weaker. Your dollar just doesn't go as far as it used to. Grasping this one idea is the key to understanding everything else.
Think about it like this. Money is basically a yardstick we use to measure economic value. If you have one yardstick, it has a clear, defined value, right? But what if you could suddenly print millions of new yardsticks? The scarcity is gone, and the value of any single one of those yardsticks would plummet. It's the exact same thing with money. Prices going up is just the after effect of the currency itself losing its value.
So, if the value of our money is going down, it's not happening by magic. It's being engineered. So let's pull back the curtain and look at the actual policy levers that are being pulled to create this outcome. It really boils down to three main levers that policymakers use. Now, their stated goal usually isn't to create inflation, but inflation is a very predictable side effect. Let's break them down. First up is monetary expansion. This is a fancy way of saying the central bank is increasing the money supply. They inject liquidity by buying things like government bonds, which pumps brand new digital dollars into the banking system. Now, this does make it cheaper to borrow money, which can goose the economy, but it has a massive, unavoidable side effect. It waters down the value of every single dollar that was already out there. The second lever is fiscal deficits. This one's pretty simple. The government spends way more money than it brings in through taxes. So to cover that gap, it sells bonds. But here's the kicker. Who is often the biggest buyer of those bonds? The central bank. And it buys them by creating new money. This creates this powerful feedback loop that just keeps driving more and more monetary expansion. And then there's the third factor, which is like an accelerator pedal for the first two. Crisis response. Think about a pandemic, a financial meltdown, a war. In those moments, those first two levers get jammed into overdrive. To stop a total collapse, governments and central banks roll out huge deficit spending and create money at a staggering rate. They're making a very conscious choice. We will accept the long-term pain of inflation in exchange for short-term stability right now. Okay, so now that we know how it's done, we can get to the most important question. Who? Who does this affect? Because inflation is not an equal opportunity force. It silently, systematically transfers wealth from one group of people to another. And this quote just nails it. It's perfect. Unlike an income tax or a sales tax, which get debated and voted on out in the open, inflation is a stealth tax. It just works quietly in the background, eating away at your savings, and it never has to pass a single vote. So let's break down the winners and the losers here. On the winning side, you've got debtors. If you have a big fixed-rate debt, like a 30-year mortgage, inflation is actually your best friend. Why? Because you get to pay back that loan over decades with future dollars that are worth less and less. But on the losing side, you have savers. All that cash you worked so hard to put away is silently bleeding purchasing power day after day. Same goes for anyone on a fixed income, like a retiree whose pension just can't keep up with the rising cost of living. And who is the single biggest debtor of all? The government. By enacting policies that devalue the currency, the government is also shrinking the real value of its own gigantic national debt. It's a quiet, effective way to manage its own books by pushing the true cost onto all of us in the form of weaker money. So this all begs the question, right? If inflation is so damaging to savers and people on fixed incomes, why on earth do policymakers go down this road again and again? Well, the answer comes down to political convenience and some pretty powerful incentives. Let's just be blunt about it. Raising taxes is politically toxic. Cutting popular spending programs is just as bad. It guarantees screaming headlines, messy public fights, and it often costs politicians their jobs. Inflation, on the other hand, lets the government fund its spending without having to go through that painful process. It is, quite simply, the path of least resistance. And this political convenience is all rooted in a really fascinating incentive structure. The costs of inflation are what you call diffuse, while the benefits are highly concentrated. Let me unpack what that means because it's super important. Diffuse costs are those little price hikes that everyone feels everywhere. It's an extra 30 cents for your coffee, a few more bucks on your electric bill. Now, over time, it adds up and it's deeply frustrating. But the pain is spread so thinly across millions and millions of people that it's almost impossible to organize a political movement against it. Who do you protest? What specific policy do you blame? It's really hard. But the benefits? Oh, they are anything but diffuse. They are highly concentrated. Think about a huge bank that's about to fail during a financial crisis. A policy of monetary expansion, a bailout, provides a massive, direct, life-saving benefit to a very specific group, that bank's executives, its shareholders, and its large creditors. And you can bet that creates a very powerful, very well-funded, and very organized lobby to keep those kinds of policies on the table. So as we start to wrap this up, it becomes pretty clear that this is all about trade-offs. Policymakers are constantly weighing a very obvious, immediate, short-term benefit against a much less visible, more insidious long-term cost. And here's that trade-off in a nutshell. The short-term benefit is huge. Immediate economic stability. You avoid a depression, you stop a financial collapse. That is an incredibly powerful motivator. But the long-term cost is severe. It erodes public trust in our institutions. It completely distorts the price signals that a healthy economy needs to function, which ultimately slows down real growth for everyone. Look, the goal here wasn't to tell you what to think, but maybe to give you a new framework for how to think about this stuff. Because once you see inflation as a policy choice, you stop asking, why are prices so high? And you start asking a much better question. Which policies are making my money worth less? And who exactly is benefiting from it? And that really brings us to the final lingering question. When you have an incentive structure like this, where powerful organized groups get huge concentrated benefits while the costs are spread invisibly across everyone else, what real incentive is there for any policymaker to ever give up the most politically convenient tool they have? Something to think about. Thanks for joining us.